7 tax write-offs. Freelancers are missing in 2026. The IRS won't tell you. Hook. You are handing the IRS money you do not owe right now, today. Most freelancers overpay their taxes by thousands of dollars every single year because nobody sat them down and explained what they can actually deduct. This video fixes that. 7 write-offs, real numbers, and 1 rule change that went into effect this year that every self-employed person needs to know about right now. Let us go. Write-off 1. The 1099 rule change that confused everyone. Here is the news hook first, because this has caused mass confusion online in 2026. The IRS raised the $1,099 NEC reporting threshold from $600 to $2,000. That means if a client paid you $1,500 this year, they no longer have to send you a 1099 form at tax time. Here is what most people get wrong. They think that means the income is now tax-free. It is not. Every dollar you earn as a freelancer is taxable income. The 1099 form is just paperwork. Whether or not you receive that form, you still owe self-employment tax plus income tax on everything you made. The change is about what clients have to report, not what you owe. The real danger of this rule change is that it makes it easier to accidentally forget to report income. Do not do that. The IRS cross-references bank deposits, payment processors, and client filings. The threshold changed. Your obligation did not. Now, with that cleared up, let us talk about how to legally reduce what you actually owe, because there is a lot the IRS does not volunteer. Write-off 2. The home office deduction. If you work from home, you can deduct a portion of your housing costs as a business expense. Rent, mortgage interest, utilities, internet, all of it becomes partially deductible. Most freelancers either skip this one entirely because they think it is a red flag, or they calculate it wrong and leave money on the table. The IRS gives you 2 methods. The simple method, $5 per square foot, maxed at 300 square feet, for a maximum of $1,500 per year, takes 5 minutes. No receipts needed. The regular method, calculate the percentage of your home used exclusively for work, then apply that percentage to every housing expense. If your office is 200 square feet in a 1,000 square foot apartment, that is 20%. Apply that to rent, utilities, and internet, and you might be deducting $3,000 or more per year. The key word is exclusively. The IRS requires the space to be used only for work, not a kitchen table you also eat at. A dedicated desk in a separate room qualifies. A couch you work from sometimes does not. Run both methods. Use whichever number is bigger. Write-off 3. Mileage at 70 cents a mile. The IRS standard mileage rate for 2026 is 70 cents per mile. Every mile you drive for business, client meetings, shipping products, going to a co-working space, is worth 70 cents off your taxable income. If you drive 10,000 business miles in a year, that is a $7,000 deduction. Most freelancers are leaving thousands of dollars on the table because they did not download a mileage tracking app. The rule? The drive has to be for business, not commuting to a regular W-2 job. Self-employed people going to client sites, supply runs, meetings, those qualify. Driving to your regular job does not. Tracking options: Mile IQ, Everlance, or even a spreadsheet with date, destination, and purpose. The IRS wants a contemporaneous log. Keep one. This deduction disappears without documentation. Write-off 4. The QBI deduction, worth 20% of your income. This is the biggest one and the least talked about. The qualified business income deduction lets most self-employed people deduct 20% of their net business income right off the top, before any other calculations. You do not need a special account. You do not need to spend money on anything. You just have to qualify, and most freelancers do. Here is a concrete example. You made $80,000 freelancing this year. After business expenses, net profit is $65,000. The QBI deduction takes 20% of that, $13,000, directly off your taxable income. You are now being taxed on $52,000 instead of $65,000. That is potentially $2,000 to $4,000 in actual tax savings depending on your bracket. There are income limits and some profession restrictions. High earners and certain service fields like law and financial consulting have phase-outs. But if you are a freelancer making under $200,000, there is a very good chance you qualify for this deduction and have never used it. Pull up your last tax return and check Schedule A for the deduction on line 13. If it is blank, talk to a CPA. That blank line may be costing you thousands. Write-off 5. Half your self-employment tax. This one sounds confusing, but it is simple. As a freelancer, you pay self-employment tax, Social Security and Medicare, at 15.3% on your net earnings. That rate hits hard. What most people do not know is that the IRS lets you deduct 50% of that self-employment tax as an adjustment to your gross income. So if you paid $7,650 in SE tax this year, you get a $3,825 deduction automatically. No spending required, no receipts. It is built into the tax code. But you have to file Schedule SE to calculate it correctly and know to claim it. This deduction exists because W-2 employees split that 15.3% with their employer. Each side pays half. Freelancers pay both halves. The deduction is the IRS acknowledging that reality and giving you partial credit. Take it, every time. Write-off 6. SEP IRA, shelter up to $72,000 from taxes. Here is how you go from paying taxes on $65,000 of income to paying taxes on $40,000 of income, legally. A SEP IRA is a retirement account designed for self-employed people. In 2026, you can contribute up to 25% of your net self-employment income with a hard cap of $72,000. Every dollar you put in reduces your taxable income dollar for dollar. Concrete numbers. Net self-employed income, $65,000. SEP IRA contribution at roughly 20% after the SE tax adjustment, $12,000. That $12,000 comes directly off your taxable income. You are deferring taxes, building retirement savings, and lowering your bill simultaneously. Here is the part that people miss. You have until the tax filing deadline, including extensions, to open and fund a SEP IRA for the prior year. April 15th, if you file on time, October 15th, if you extend. This means you can make the decision after you know your income for the year. It is one of the most powerful and flexible